Rick Santelli standing by at the CME in Chicago. He's going to just have a bunch of numbers and comparisons in about 2 seconds. Hey, Rick.
Yeah, that's absolutely true. Consumer Price Index for the month of June. We're expecting a headline number to be in the neighborhood of up 0.3, but I'm going to be paying most attention to the core at up 0.4, our last look, and I'll tell you why in a moment as we wait for these numbers to populate. And here we go. If you look at the headline, up 0.2%, up 0.2%. And that, of course, comps to the up 0.1 in the rearview mirror. It's a 0.1 lighter than expectations. Now, CPI core ex food and energy up 0.2, up 0.2. And that means it's not the fourth consecutive month up 0.4. And it also means it's not the seventh month in a row of 0.4 or higher. And that was a record going all the way back. The last time we had something along those lines was from October of 89 to April of 90, where it was 9 in a row. So we stopped that as well. And up 0.2 on the core is the lowest level going all the way back to February of 21, when it was only up 0.1. And if we look at year over year, up 3%. 4% in the rearview mirror. Well, 4% in the rearview mirror was the lowest level since March of 21. So when you see 3%, you have to go all the way back to March of 21 again, because that's where the comp drops from down to 2.6 is what we're comping to. And in the rearview mirror, 4%. And here's another one. If you look at ex food and energy, last month it was up 5.3. That was the lowest level since Nov of 2021. We breached 5% to 4.8. 4.8, and that remains at the lowest level since October of 21, when it was 4.6. We could see that interest rates have fallen about 3 basis points in tens from 393 to 390. We see that the pre-opening equity markets have rocketed higher. Dow futures up basically 200. And, of course, we are going to monitor if there's any changes in Fed fund futures. I don't think so. At 10 o'clock Eastern, look for Bank of Canada to go 1/4 point to 5%. Dollar index prior to this number, of course, was at a 2-month low. My guess is it's not rallying at this point. And we're all going to pay attention to the UAW. You know, wages are a big issue, as we learned last Friday, and UAW and strikes and minimum wages across the country. All of those things may be good for many people, but there's very little doubt that they also fuel some wage inflation. We need to pay very close attention to that. Joe, all yours.
So no change in so Bookvar was on. He said they're going in July no matter what. No change in that probability?
Well, it's dropped a little bit, and it's slow moving right now in the futures, but we've gone from basically 88, 89% where it's been hovering for pretty much since the non-farm numbers. We lopped off a couple of percent to maybe 86%. And, Joe, you know, I have cheeseburgers bet with Steve Leisman, and I really don't think they ought to go, but it's very hard for me to think that they're going to be dropping that 86% anytime soon. They seem to always like to make sure the market and the Federal Reserve voting panel are in sync, as they seem to be. I think the real issue is September. I don't think they'll go in September, and I think a year from September, they'll regret going in July.
So where should Fed funds be? What should we assume about core? It's in a downward trend, and then how much should we add on core to get to the Fed funds? Where should they be? Given what we just heard today, what's the number where they should feel comfortable with? Where, you know, if you don't put people out of work, it would be nice. If you don't
it's a moving target.
Yeah, it is. Okay. So, but approximately.
It's a moving target. So, you know, let's look at where CPI core has been, okay? So it peaked in what? June of 2022 at 9.1%. So it went 9.1, 85, 83, 82, 77, 71. And decent 22, it dropped under 7% to 6.5, then 6.4, 6%, 5%, 4.9, 4%, and now 3%. So we could see, I'm sorry, that wasn't core. That was year over year. If you look at core, that's been much stickier. It was 6.6% in September of last year, Joe. That was a high water mark back to 82. I'll do those too. So we've gone from 6.6 to 6.3, 6.0, 5.7, 5.6, 5.5. And the fly in the ointment was, if you remember, Last February, this February of 23, we went from 5.5 to 5.6 in March. That uptick really made the markets nervous, then 5.5, 5.3, and now 4.8. Why did I do all that? Because I think that over a year, over the next 12 months, we're going to get it down very close to the Fed's target, 2, maybe 2.5%. But I don't think it's going to get there in the next several plus months. And that's the rub. So when you ask me where Fed fund futures need to be, if they're taking the tack that they need to control it immediately and see the drop immediately, they're going to have to go 2 or 3 more, in my opinion, higher than they currently are. So another 75 basis points. Maybe they do 25, maybe they do 50. But the point is, it's coming down, as I referenced, by going over all those months. And I continue to think we're not going to only see the same type of progress, albeit more slowly on the year over year, but we're going to see it continue, and it's all going to occur higher for longer. I think Raphael Bostic has expressed some of those exact sentiments. I just don't think that the central bank believes that we're smart enough to understand that if they take that tack, they're not being aggressive enough in the here and now, and I think that's the issue.